Well, good evening and welcome to the Middle Class Investor. This is Seth, your host. Well, this is going to be my second video tonight because something messed up in the recording and it didn't work out. So I'm going to try this again, probably be a little bit shorter, but hopefully we cover everything the way you expect it to be covered. All right, as normal, we've got a S&P 500 chart on the screen. Now, let me say something real quickly about profit charts. This charting software is called Profit Charts. It's inside Thinkorswim, and Thinkorswim sent a note the other day saying they were going to be phasing profit charts out. So I just want to give you a heads up that we're no longer going to have this kind of look on the screen. They've already gotten it. It's already been removed from the real-time trading platform. This is a simulated trading platform that we're looking at when we look at these videos. So I just want to give you a heads up that profit charts is going to go away. I keep a lot of long-term drawings on here, and then I trade kind of on the toss charts. Obviously, I'm going to have to change that, but just want to give you a heads up. So anyway, so here we are in what is maybe turning out to be wave E in a fourth wave consolidation. Okay. Now this is a pretty deep retracement. When you go from low to high here, we're at least 62%, maybe more. That's pretty deep. It's pretty deep retracement. So either within the next couple of 3 days, we're going to start making our way lower, or who knows, this thing can make a new high. So I just want to give you some heads up about that. All right. Although this whole pattern down here is very choppy and very corrective looking. Okay. So I would say, exercise a lot of caution about getting long the market over the next 2 to 3 days. Might want to just kind of sit on hands for a while. Now, let me say something about a fourth wave. Because we're saying this is likely a fourth wave, that means we're going to have a fifth wave and we're going to go higher prices. So it'd be interesting to see how this all works out with respect to Trump's election. I think probably what's going to happen is this trade stuff's going to get worse, and the market's going to sell off into here, and then Trump's going to get reelected, and it's going to take off. Maybe who knows? I don't know what's going to happen. There's no way to know what's going to happen. But it is interesting that this market is holding out for higher prices. I think that's very interesting. All right. Let's look at the volatility index. Volatility came in quite a bit, as you might expect. I don't think volatility is going to make new lows. I think it may come in a little lower, but I think we're going to make a lower high and kind of grind our way up to higher volatility numbers. 10-year Treasury is down. Well, let me go to the 13-week Treasury first. There's been a lot of talk about the Fed. Get off this log. A lot of talk about the Fed. What's the Fed going to do? The Fed came out the other day and said, well, we don't think we need to lower rates, which is fine. I think probably what will happen is we'll get maybe a little bit lower short-term rates, and then they'll come in and go, oh, maybe we should lower rates, Maybe the economy is weakening, who knows? Maybe it comes all the way down to here, and then they do it, and then about the time they do it, then rates will rise. One of my big hopes in this whole thing for the next bursting of the bubble is that the Fed is discredited, and that eventually we get rid of them, because they've been a net negative for the economy in general, for the average person. The only people that benefit from having the Fed are the money class, the people that use the banking system to grow their businesses, to buy other businesses. The vast majority of people out there are not benefiting from this money / banking system, and in fact, it's making us poor. The only way you can keep from getting poor is if you're growing your wealth at 10% plus every year, and then you're not, you're outpacing inflation. But the vast majority of people are not outpacing inflation. Productivity numbers have been low, historically low, although ticked up recently. And your average guy is just getting killed by inflation, and that's all about the Fed. So I'm hoping it goes away. That's what I'd like to see. All right, let's look at the 10-year yield. When I go to the TOS charts, I'll have to remember I'm going to look at the bond market, because the bond market and the yield they're not exactly inverse pictures of each other, which they, basically as bonds go up, yields go down. But in some markets, yields have made a new low, but bonds have not made a new high. So I think that's an important thing to point out. Excuse me. So I'll do that in a minute when we get to the TOS charts. Real quick, so I don't want to say much about this 10-year Treasury other than to say it's much lower than we anticipated. We were thinking the 10-year Treasury would stop right here at around 1.9. And here it made it almost to 1.4, which is really low. And right now it sits at 1.55. So let's look at these other countries. There's a lot of talk about, maybe Germany's already in a recession. I don't know. Chart doesn't really show it, but maybe it does. I don't know. Japan, I don't want to spend a bunch of time on these because I don't really follow them too much. The UK. The interesting thing about the UK, and we'll show it in a minute, the British pound, US dollar looks like it's bottomed and is turning, so that could be an important event. So we'll have to keep an eye on that. All right, let's look at TOS charts real quick. And the first thing I want to do is look at the bond market, because since I mentioned it. So we're going to look at the 10-year note, which is ZN. And notice, see down here, here's the recent price action of the bond market, but here's the high way back here in 2012. So, I'm not sure exactly what the pattern is here, but the bond market is not at new highs, even though the yields, like on the ZB, like if you go to the ZB, which is the 30-year bond, see the 30-year bond, the high was back here in 2000, what is that, 13, 2000, I don't know what year that was, 2016, sorry. And you've had this move back up. Now the bond market looks like it's topping and yields are going to start going up. And as this falls this way, let's just talk about this for a second. As this starts to make its way down, maybe like this and then like this, yields are going to be going up. That 1.5% you see on the 10-year is going to be 4%, and it's going to create a lot of havoc in our economy, our financial economy. So I just wanted to point that out. That's not something I talked about here much. We've been focused on the yields, but I think it's important to note that we are not at all-time highs in the bond market, although we're near all-time lows in the yield. Okay. All right, let's look at gold. I think that's an important market right now. We want to focus on that. And just to recap, gold is in a big bull market. This potentially being the first move off the low. Then we've got a corrective move back, and we've got this yellow box here. Now it looks like we're a long way from this, and we are a long way from this. It could be years, could be 3 or 4 or 5 years away. But I do want to point out that the gold market is turning right here at a point where it's pretty common. 100% and 1.27% retracements are very, very common. Now I had it at 100. I think, I like to be conservative. So if I'm long and I'm trading up, I want to try to take my profits here in around 100%. But the 1.27% area is very very common as well. And you can see the bond market, the gold market looks like it's turning right there at that point. So I would not be long gold here, wouldn't be long silver either, although silver doesn't, it's kind of just the opposite. It hasn't gotten even to the 100% area, which means it could be a slightly different pattern than gold. It could be slightly disconnected. And that doesn't mean that silver is going to turn over right here. It may just pull back a little bit and then maybe rally into this 22 area. Who knows? I don't even know. I just know that, when you start seeing, candles like that, you got to be real careful about being long. You want to see some reasonable looking pullback pattern before you get long silver again. Okay. Let's look at the Euro US dollar. So potentially this has bottomed. Not sure. I've been picking at it, trying to figure out where to get in, and maybe this is the right place to get in. I don't know. I just know that it's been a little bit of a challenge. I got in here and here and kind of got out and got in here and got out. I've been in and out of this thing several times. I'm just barely profitable in it. I think I looked at it the other day and I was only like $250 to the profit side, and that doesn't include the interest expense that they give you. That's probably a valid point to bring up, because I haven't talked about it before. But when you trade something where the US dollar's in the denominator, so like here it says Euro/US dollar, US dollar's in the denominator. If you're long this instrument, so if you're long the euro, you have to pay the interest rate differential between these two countries, which right now is like, it's like 7% or something like that. So in other words, let's say I'm in this and it goes up $100 in one day. Well, I have to pay $7 in interest for that day, and then the next day it goes up another $100. I got to pay another $7 in interest. So every day I'm in there, I got to pay another $7 in interest. Now, when you're short the euro, when you're short an instrument like this, you get paid interest. So it works for you in that case. These are just things you need to be aware of if you're going to trade these pairs. Now, if you're trading the actual future, like the /6E is the euro. So if you want to be long futures, the 6E, you don't have to pay that. You don't have to pay a futures contract price, but you don't have to pay interest. So anyway, just incidental information I just thought of while I was sitting here talking. I thought I hadn't brought that up before. Here's the British pound US dollar. So another one you have to pay positive interest on, but it does look like it's trying to bottom here. And we got, the MACD is turning up. If you go to a daily, the MACD is already turned up. It's turned up here and it's bouncing. So, we might get a little pullback into this area and then rally up again. But I think this is an interesting market. Let me go to Max. Interesting market to look at right now. The British pound, US dollar. I think that's key right there. And then this looks to me to be finished. This looks like a 4 and then a 5, and then we're rallying out of that. So we'll see. All right, oil. Oil, has been trading sideways. We've known that for some time now. What we were expecting here is that for it to make its way, down into this area, get kind of an ABC pattern going for this sideways consolidation that we're expecting in oil. That may or may not be happening. I don't know. It's hard to tell here. This very much looks like the first move, like of an A, but B looks like it's having a hard time. I mean, B's done, but it looks like C's having a hard time getting started. And maybe we can go all the way back up here to $62, because maybe this is a 1, and then you got to go A, B, C back up here to $62, and then roll over in 3, and then 4 and 5. So I don't know. We'll see. It's hard to tell right now. It's very, very, very tricky market. If you're trading oil, that's fine. I wouldn't be long or short here. I'd wait till it either pulls back down into this area around $35, or it rallies into this area around $70. That would be my that's what I would look for. So, which is an interesting point. I was talking to somebody the other day, and I just want to bring this up. They made a comment. I think we were talking about platinum. But they made a comment, and I don't have platinum up here. Maybe I can pull it up. This person made the comment that I know platinum is going to such and such. And I'm like, well, you don't really know. I mean, I understand you're saying you know, but you don't really know. So, all we can really do, or what we should be trying to do, is looking for places that if the market goes to, we want to be a buyer or seller. So on this chart, I mean, we have a series of higher lows. Here's a low, a high, a higher low, a higher high, a slightly higher low, and a higher high. I mean, that sounds like an uptrend. Now, where do we want to be? Let's assume this is an uptrend. Where would we want to be long? Where do we want to get long if the market does manage to come back to a place? Or where do we want to be short? So let's talk about the long side first. So if the market makes its way back down into this area and then starts to rally, I mean, we want to be long right here, right? Let's get long, okay? If the market, well, to see where to get short, we got to go to a bigger picture. So where's the last swing? The last major swing is right here, right? This was a swing into the low. This move right here. Can everybody see that? This move right here was into the low. So this pivot right here, so I'm going to draw it. This pivot is important. Okay, this pivot right here is important because this is the low. This is an important low right here. Okay, so what we want to do is we want to say, okay, well, the market, you know, if it gets into this area right here, then we might want to be short. Okay, if it gets into this area right here and starts looking like, you know, kind of tired, we might want to get short back down into this area where we get long again. So maybe short right here, long right here. Now the reason I'm using this diagonal trend line here is because sometimes, you know, I mean, it won't come all the way back. You know, yeah, you got to pivot. You got to pivot here into the most recent high, but it may not come back to this. Okay, so if you're waiting for that to happen, you might be waiting for a long time. So sometimes a diagonal trend line is a good place, but as far as getting short, you know, this pivot here is a pretty important pivot. This is super important. The reason it's important is because it's the last swing into the low. It's the most recent high that went into the most recent low. So that's an important pivot. So this area right here is a very important area. Okay? So it's not about what you know. Okay? It's about where the risks are reduced and the rewards are high. That's what it's about. If you look at the bigger picture here on platinum, you know, I don't know what's going on here. I mean, it looks like this could be an A, B, C, and maybe we are going to make new lows, you know, and obviously this pivot right here is important, right? This pivot right here is super important on the major long-term scale. And to me, this kind of follows just the general commodity deflation story. We're going to have just a general deflation in commodities. Okay, so maybe what happens is platinum goes up here. I mean, this could be, I mean, this is plausible, right? Because this is the last swing into the low right here. So maybe platinum goes up into here, into this area, and then reverses and makes a new low. You know, maybe this is maybe this is a, you know, kind of 4, and this is 1, 2, 3, 4. You know, I don't know. I mean, I don't know what I'm looking at here, but my big point is just to say you don't really know what's going to happen. All you can do is kind of pick places on the chart where the risk is minimal and the rewards are great, and enter the position. That's essentially all you can do. So anyway, with that in mind, let's go back to gold. So gold is at one of those places right now. At this very moment, it's at one of those places. So, you know, if you want to short gold, be my guest. You know, it's probably coming to, you know, over a very long term, like over a year period, 2-year period. It's probably coming all the way to this 1100 area. But you got to have a stop in there. You got to try to minimize your risk with stops. Okay. All right. I think that's it for this week, everybody. I think I've exhausted what I wanted to do. Well, actually, let me show you one thing. Let me show you a couple things real quick. This is the Elliott Wave financial forecast. Here's the big picture. This is what we're looking at. This is a primary wave 5. So primary started back in 2009, which was the low after the financial crisis. You can see here we have a 1, we got a 2, and then a 1, 2, 3, 4, and then a 5, and then this is all 4, and then we got a 5. So when this is complete, some or all of this whole move will be retraced, and that's what we're going to try to prepare for. One of the things I wanted to point out, and I think is super good. This is kind of all the different sovereign bonds along the debt curve. And you see, here's all the negative yields down here. They call it the twilight zone. Excuse me. And then you got the crisis zone, Turkey and Argentina. And this is where things could get started, you know. Either in Turkey or Argentina, and they could spread to here. This is what I wanted to point out with gold, or just, this is one of the great things about Elliott Wave financial forecasts, is they track this large specs and commercials, and when they're close together like they are right here, it usually marks the bottom of something. So this bottom corresponds with where they're really close together. And where they're really far apart, like this, that usually marks a top. So why does this happen? I want to cover this real quickly because it's super important and it's a great tool to use. The problem is not many people publish this type of information. So you have to get it from like Elliott Wave or somebody. But why does this happen? Okay, so commercials. What are commercials? Commercials are people that are actually in the business of producing gold. Okay, they're the ones that dig it out of the ground, refine it, and then melt it into gold bars and sell it. So they're like just like a producer of coal or any other kind of producer. And so what happens is there's actually some supply and demand that works here. So what they're saying, what the commercials are saying is, look, at this price, at this $15.50 or wherever we are right now, we can sell gold, because they know what their cost is. Okay, they're looking at this and they're going, we can sell gold for years. We can sell gold for the next 5 years at $15.50. So what happens is, yeah, they're still producing, But what they're doing is they're going and they're saying, golly, man, if people are willing to pay $15.50, let's go sell a bunch of contracts in the market. So they're selling a bunch of futures contracts, and maybe out over a couple of years, 2 or 3 years, they might be selling futures contracts that are going to be good for the next 3 or 4 years, even at this price. And so that's how these get wide. Now the people on this side, the large specs, they're basically trend traders. So they've been making money all along the way, and they keep adding to their positions. And what happens is they're pressing, and eventually what happens is, some percentage of that money finds itself on the wrong side of the bet, and then the market turns. Okay, that's kind of how it works. But these commercials are always on the right side of it because they're in the business. They're looking at going, golly, man, gold, our cost to produce a ton of gold or an ounce of gold is, I don't know, $700. So at $15.50, we can sell gold for the next 10 years at $15.50 and still be profitable. So what they're doing is they're going out and they're actually selling contracts to hedge themselves out into the future. So they're always right. It's just at some point it becomes an economic decision for them to sell contracts. They're always in the market, as you can see, but when they're extremes or they're very close together is when things tend to turn. So this is a really, and you'll see this in the bond market. You'll see this in just all kinds of different markets, and Elliott Wave tracks this to a large degree. You can see here silver. They're saying silver's complete. British pound, same thing I said earlier. British pound's it's a great time to buy sterling. We got a low, and then a higher low, so we should rock it. Now look at large specs. Now see here, they did the same thing on the British pound. They got large specs up here. Trend traders are saying, no, this is going lower. They're selling contracts. Okay, selling contracts. They're thinking this trend is going to continue, and the commercials are saying, nope, we don't think. The commercials in this case are like banks and stuff. So the banks are saying, no, we want to be long the British pound right now, because they have, again, it's their business. They have access to flows like dollars and pound sterling, how it flows back and forth between the countries, and so they know it's their business. They know that there's a lot of dollars coming in that are being sold against British pounds. So people are wanting to buy British pounds and sell dollars, and so they see that in their banking system. So they come in and they get long futures contracts. It's their business. So these are very good charts, and you can see here, where they were really close together. That was a good move up. Here they weren't as close together, but it was still a decent move up. See all these areas where they were close together, decent move up. And here, see, they were really far apart way back here, and what happened? Big fall. Okay, big fall. So now we're close together again, and we're almost record extremes. This was a record extreme, but we're almost there, and it's probably a good time to be long the British pound. All right. I think that's it. I think that's all we want to cover today. So I appreciate you coming in. If you have any questions or comments, put them in the comment section. Let's talk about it. If there's something we should be talking about on here, then let's talk about it. I'm happy to do that if it's something that I feel comfortable talking about. If not, we'll talk about something else. All right, everybody, be careful. Keep those stops tight, and we'll talk to you next week. Thanks, everybody. Bye-bye.